This is BBC News. I'm Ben Brown. The headlines at 9.
A quick forward summary of this article is mostly regarding the disadvantages that management accounting presents. I've summarized the introduction into 3 main points, which is I will now discuss the first point is that it does not help operating managers cut costs or improve productivity. Now let me explain. Management accounting reports requires operating management to invest a lot of resources into understanding and explaining the many variances and other technological. Also, they do not provide timely and detailed reports. And one more thing that is focused on is the management accounting reports focus too much on inputs. Now, I would like to explain the second part of my quick summary. It fails to provide accurate information, as I've said in the points before. So, regardless of what kind of company you are, management accounting reports always talk about labors, direct materials among all companies, most companies. And the next thing I would like to discuss about in the introduction is a manager's horizons are shortened to focus on short-term goals as opposed to long-term goals. When you see companies these days are always chasing profit, that is a must. Every company, every business is always chasing after profit. But what management accounting does, it pressures managers into making short-term goals as opposed to long-term investments. So a company may gain profit in the short term but will fail to grow later on in the years. And investors will get little to no return as a result.
I will explain the challenges in rise and fall of management accounting. There is many factors that the challenges can arise in management accounting, such as competitions that happen in the global fluctuations, currency exchange rate, and also rapid growth in product and process technology. Next, we have how to overcome the challenges by management accounting. First is management accounting should provide timely and accurate information of the organization. Secondly, management accounting should report the product cost precisely so the decision makers can choose the best decisions for the organization. Thirdly is management accounting should encourage and evaluate the performance of the manager. Last but not least, management accounting can act as two-way communication from top management to lower and from lower to top management. However, good management accounting is not a guarantee of success to the organization, but at least it can improve the efficiency performance. The success is rely on production meet customer needs, what the customer wants, efficient production, distribution system of the product, and also effective marketing effort. So that's all.
The next I will discuss about the opportunity of management accounting. The demand of the excellent management accounting system increased due to the decrease in cost of collecting, analyzing, processing, and reporting information. Since the organization uses the direct control of digital information, it may result in high quality of performance on their business operation because the information can be recorded in general time. Thus, with using the highly automated environment compared to the local area network. This can provide the continuous status report on the work in process. Other than that, the sophisticated electronic technology can be used to help the reporting and controlling system to be more timely, accurately, and efficient. That's all for me.
Alright, next subtopic is management accounting risks. So, in this subtopic, I'll discuss about 5 things, which is before 19th centuries or 19th centuries, middle of 19th centuries, late 2 decade of 19th centuries, and early decade of 20th centuries. So first is before 19th centuries. Before 19th centuries, the exchange transactions only happen between the owner and individual who are part of organizations, like customers and raw material suppliers. Next, there is no level of management, which means no hierarchies, no CEO, no director, and so on, and no long-term employees. And then the owner need to collect more cash sales to customers rather than paid out to the supplier. Alright, next is on 19th centuries, also called as industrial revolutions. So, in these centuries, the owners start to commit a lot of money in the production process and they start to hire long-term employees to avoid bearing all the costs and risks in the labor market. Alright, next is lacking in the prices information has occurred in the conversion process because of these dimensions. The owner device to measure the efficiency by which the labor and material are converted into finished good, and they evaluate the manager who supervise this conversion process. This measure, it seems very simple, but the needs of managers and owners seems to serve very well. Next is on middle of 19th centuries. So a good advance in the communications and transportations happened especially during inventions of railroad and telegraph. This is because they gain more on access of acquisitions of raw material and distributions of a final product. Therefore, effective and efficiencies of management accounting is necessary to keep up the quality and the quantity. Besides, many retailers develop their own measure on internal performance to support their control activity and managerial plan. The last 2 decades of 19th centuries or scientific management movement. The goal is to improve the efficiency and utilizations of the labor and physical standard. The finished good unit cost will calculate to aid managerial designs, not to produce external financial standards. Alright, so last is on early decade of the 20th centuries. So on this early decade, the development has happened and is for to support the growth of multi-activities and diversifying operations. So return on investment or ROI is the most important for management accounting innovation as it provides overall measures for commercial success of each operating unit and for entire organization.
The last relevance of management accounting. By 1925, all management accounting practices that are practiced today had been developed. This practice had evolved to serve the information and control needs by the managers, to increasing their complex and diverse of organization. But the pace of innovation seemed to stop in the middle of 1920. Perhaps there were little incentive to continue to develop innovative management accounting system because the corporate organizational formed by the successful companies such as DuPont and General Motors to prove to be the model of many corporations for the next half century. After the 1920s, the evolution of management accounting system still did not keep pace with the improvement of corporation product and process technology. During the 20th century, the dominance of external reporting when calculating the cost of goods sold and value the inventory cost. They insist on using the historical transaction recorded in the firm ledger balance, which ignore the real market value at that time. Thus, it did not show the reality on economic position for the organization. In early 20th century, the manager did not have to yield the design of their cost accounting system to their financial accountants and auditor because they could have maintained separate system for managerial purpose and external reporting. But the information technology did not make such as parallel system and cost effective, so that the organization more focused than the today organization because this will destroy the effect from using the simplest method to attach the cost to product was as severe as it will become today's. That's all.
I will explain about academic-led extreme. This article in this question is why the university-based researcher is failed to note obsolescence of organization management accounting system and why did they not play a more active role to improve the art in management accounting system design. Here are the answers. The academic focused too narrowly on simplified models of firms' behavior, influenced strongly by economists' one production's process models of the organizations. Management accounting academics found a little value in the cost allocations imposed on the organizations. They are very persuasive when illustrated in a simple one-product setting used by academic economists and accountants, never fully address the questions of where fixed costs came from and how the costs needed to be covered by each of the product, and never implement their ideas in the environment of actual organization with hundreds or thousands of products and with complex multi-stage production process. Secondly, management accounting system become less relevant and less representative of the organization's operation and strategy. It is because many companies dominated by senior executives who believe they could run the firm by the numbers. Lacking knowledge and uncomfortable with your firm's underlying technology, it will impact the project short terms, especially on the earning per share and return on investment. But as the product life cycle are shortened and more costs incurred before production begins, directly traceable product costs become a much lower fraction of total costs. Consequently, traditional financial measures such as product earning and accounting return on investment become a less useful measure of corporate performance. That's all.
So now I would like to get into another subtopic, which is accounting for caravan. So we date back to the 15th century of Fra Pacioli and whereas what kind of events occurring will lead to demand of accounting information. You know, back in the day, in the 15th century, people didn't have a reliable source or a reliable way to manage their income or manage their cash flow. So that was what brought in the demand of accounting itself. If we didn't have accounting during back in the 15th century, this would have been a very difficult feat to measure the profits that you would gain from a trip, because it was a long trip to travel from one side of the world to the other to purchase goods and to turn back and sell those goods for a profit. That's what was one of the reasons accounting was mostly needed back in the 15th century. Now, accounting back then, the worthwhile role of accounting was it computed overall profitability of the venture and to distribute the net proceeds among initial investors. However, did the investors or the Venetian version of did the investors also ask the accountant to compute the expedition profits during the third quarter of the year while the caravan was traversing Persian desert en route to India? The answer is no, because investors understood that allocating the total profits of expenditure to periods as short as 3 months was not meaningful exercise. This is another point where they focus more on long-term goals as opposed to short-term profit.
Right. Last but not least is innovation. Innovations are really needed in these cases to improve more in management accounting. Management accounting need to be designed to support the strategy in the organizations. The technology that already exists the function is to implement the system that is differently from the 19th century. The only problem is that knowledge. The knowledge can appear with doing experimentation and a good communication. Thank you.